Very quickly, I'm not a financial advisor. I'm not licensed in any way. This is not a financial advice, not a recommendation to buy or sell anything. Do your own due diligence and, well, do find a trusted licensed financial advisor. Not all financial advisors that are licensed are their license doesn't mean they're capable. Okay, they are supposed to be okay to a certain extent, but I do know of financial advisors who are good and financial advisors who are more interested in making their commission more than helping you. It is their job, but you know what I mean? They're the good ones and they're the one that's like not so mature enough to help you. So, Investing University, let's go into it. Today, we're going to talk about cash flow statement. Previously, we talked about income statements. We talk about balance sheet. Today, cash flow statement. And let's put some things into perspective. Now, by the way, in case you think this is boring, this part is very exciting. It will open up your eyes to how the business and investing work, okay? So now, let me share with you all this particular story called the Enron scandal. If you heard of it, can you help me type E? If you have never heard of it, you can type 0. It's either you are not well read or you are extremely young. Okay, well, quite a number of you guys heard of the Enron scandal. Now, let me share with you what happened. A lot of people lost their retirement fund. It became a big thing in the auditing world. Some of the big 4, big 5, okay, it used to be a big 6 if I'm not wrong. If you've heard of big 4, it's a PwC, Deloitte, Ernst & Young, and what's one more? Shucks, I cannot remember. Okay, doesn't matter. So anyway, my wife used to work in one of the big 4. It used to be big 6. There's the Enron scandal. One of them get closed down. I think AT&T. Was it AT&T? Sorry. Arthur Andersen, right? Arthur Andersen got closed down when the people raid their company to go and check about the Enron scandal. They were caught shredding the paper. So they were actually caught shredding the paper when the federal officers actually came in. So very big issue. Now, let me explain to you what happened so that we can become wiser and learn from things that happen. Now, let's talk about this portion. Now, Enron was one of the very, very highly looked upon companies and stock to invest. Earnings per share. This is how much they've been earning, okay, for quarter after quarter, year after year. They make more and more money, more and more money, more and more money. Now, on surface, just based on this fact, since they make more and more money, can we consider them a viable and a possible investment? If you think they are, in the comments type I. Like, yeah, possible, I'm going to invest in them. Now, if let's say I see a company, right, that earns money so nicely, I will be interested. But at this point in time, you can see the share price drop because they realize something. So on paper, on accounting, every year when they do the auditing, yes, they are earning the money. However, let me explain to you how businesses make money. I'm going to use an example of, let's say, an interior renovation company. So let's say this company wants to renovate their building. And then what they do is they buy the services. They say, okay, I would like to actually ask you to renovate. Please renovate my building. Here's $1 million. Just an example. 1 million is a bit very cheap for renovating a whole building, but you get the idea. Okay, so this company, this renovation company, will say, cool, okay, I'm going to renovate. And then after renovating, or they start everything, and then after that, right, let's say they sort of completed the services. They will send the invoice. Usually it's by sequential, correct? They will do the first half, second half. But I'm just going to keep it simple. Let's say they renovate it very quickly, and then they send the invoice. And once they send the invoice, right, okay, what happened is, on their income statement, you will see a revenue of 1 million. Now, does it make sense? Have they made the money? Now, in accounting standards, have they made the money? Answer is yes, because they deliver the service, they sort of invoice them, okay, they make that 1 million. So let's say after minus cost, minus salary, the profit is 800,000. Great. This year, we make near $800,000. Then, okay, what happened is, because they send the invoice, this building company, right, okay, this company, the customer, have not paid them yet. So on their balance sheet, it is called receivables. Receivables means my customers is going to pay me soon. Now, this receivables is in 1 million. So what happens is this one. You must understand that after delivering the service, the renovation company has increased their revenue by 1 million. Now, is that good? It's good news, correct? Would you like to make an additional $1 million in revenue? Likely. Okay, so the second portion is their assets also increased by 1 million. Yes, I'm 1 million richer in terms of net worth as well. So is this a good thing so far? Yes or no? The answer is yes, basically. Okay, you don't have to answer me. Now, then the last part, when this company pays them that 1 million, this 1 million turns into cash. It's no longer receivable. Initially, it's receivable. Receivable means, okay, this 1 million is going to collect later. But now it becomes 1 million in cash. And it will go inside the cash flow statement, which is what we want to talk about today. Okay, so far, is this intuitive and clear? Does it make sense? If it makes sense, help me type M for make sense. Okay, now, let me share with you the story of Enron. Enron is a very typical company that is doing business. And let me tell you how to get rich quick and make billions. Because what they did is, same thing. This company actually want to buy their assets. There are some assets that they want to sell away, and they want to buy them at billions. Way above market valuation. why would anybody want to buy your assets at above market valuation? Why is this asset so valuable? Think about it. This company also purchased billions in dollars worth of services from Enron. Enron, by the way, is an energy company. They provide electricity and things like that. Okay, so Enron sends the invoice and clock as their revenue. Yeah, maybe they want to buy the asset to extend their arms. Okay, so now what happened is in their income statement, you see billions of dollars of revenue and profits. Enron is an amazing company that managed to make the shareholders a lot of money. Now, in their balance sheet, same thing, they have the receivables in billions of dollars. But the story ends here. The end. Now, if you remember, there's supposed to be another step that happens, which never happened in Enron's case. What was the step that happened that did not happen? Now, the revenue looks very good. The profit looks excellent. The balance sheet, the assets look like, boom, my net worth is increasing. What is missing? The thing that is missing is cash is never collected from this company. There's no cash. So their cash flow is empty. And investors have never attended Tribe Tuesday's lesson. They did not understand they need to look at cash flow. Now, turns out to be this company, after digging through, this company belongs to Enron. So Enron went to Accra. Okay, I mean in Singapore it's called Accra. They went to open up a lot of companies, company A, company B, company C, company D, company F. And these small little companies, masked as a different name, went to buy Enron's asset, went to purchase the services, and Enron has been clocking revenue after revenue after revenue. Wow, we got a new client. The new client wants $10 billion worth of services. We have delivered the services. The new client wants to buy our old computers at billions of dollars. Let's sell to them. And the shareholders are so happy with them. Enron is so brilliant at making money. They are able to find so many suckers that's willing to pay so much. Little did they know that these suckers are actually created by Enron. These are called special purpose vehicles. Okay, anyway, basically, in case you didn't know, in most of the countries, it's not difficult to just open a company. Okay, within probably like 24 hours or a few hours, okay, the company is open. And guess what? These are the actual companies that took place at that point in time. It's called 𝗄𝗏 Investment, named after Chewbacca from Star Wars, LJM1, LJM2. So all these companies, right, I think a lot is from Star Wars, I'm not too sure why. Okay, so they created all these weird companies to go and buy things from Enron. And all these weird companies are created by Enron's somebody who go and create the business. Do you all see the problem now? Do you see how to make money already, guys? This is how you make money. Just create a company, ask the company to buy services from you. You sell to them. On your income statement, you can clock that you have huge profits. By the way, this is a true story, in case you all didn't know. So after the whole incident happened, they say, crap, we should have looked at the cash flow. Why didn't we look at the cash flow? Now, by the way, there's another saying, I forgot to actually put it into my PowerPoint slide. They say that revenue is vanity. So it's just a very nice facade. A lot of people can make revenue and you don't know whether the revenue is real. Okay? Profit is sanity, but cash is reality. If that company doesn't have cash, the company is a weird company. Okay? They can say they make a lot of money, show me the money. So now let me give you an example. So can't really find Enron's past 10 years result and things like that because no longer existent. But there are some case studies at the point in time they captured. Now let me show you guys. This is earnings per share. This is the cash flow, free cash flow. I'll explain to you what it means in a moment's time. So this small little sum, 0.71, 0.17, 0.2, 0.27, 0.2, all this is Enron's earnings per share. So every single year, they have been making money for their investors. And some years it becomes more and more. Their earnings per share becomes 0.3, 0.4, 0.37, 0.37. So on paper, their earnings per share, as we saw just now, it grows from 0.17. And then this one, by the way, is quarter by quarter. It's not even year by year. So if you add up together, every year they are making more and more money for their investors, for their shareholders. However, this is cash flow, okay? Out of the don't know how many quarters, right? Every year, they have money flowing out of their bank. When net, right? Okay, sometimes money will come in, sometimes money will go out. But every year, it is net outflow, net outflow, net outflow. And how do they get all this money to net outflow? They keep borrowing money. And then at the end of the year, by right, borrow money, the money should come into the bank. But at the end of the year, more money flows out than comes in. Now, if you have learned how to read cash flow statement earlier in like before you invest into Enron, there's very high chance you will not invest into Enron. So that's why the next lesson is very important to make sure you know how to invest into companies that have a good cash flow statement, a decent cash flow statement. Okay, I hope that this scares you. Does this scare you guys? Because literally a lot of retirement fund went into Enron and it disappeared. Okay, so you must know that even people who, like even bankers or even certain like sovereign wealth funds, right, they also invest into Enron. These are the smartest of the smartest people, and this escaped their eyes. Right now, you no longer will fall trapped into this because you know how to actually look at cash flow statement. And the funny thing is, there's so many advertisements on Enron. They are one of the big companies, the top 100 companies to work for, the most innovative company for 6 consecutive years. Hey, they are not wrong. They are innovative, but in the wrong aspects. They have very creative accounting department, okay, which is not the place that's supposed to be creative. Okay, got it? And they are the best CEO, which is 𝗲𝗲 𝗂𝗃𝗃𝗃𝗃, okay, which is from Enron. So now, guys, I'm going to quickly explain to you what's cash flow statement in a very broad manner because there's a lot of details into it. And different types of industry, right, their cash flow statement may be different. Example, banks, their cash flow statement, it will not be the same as normal cash flow statements. And also REITs will also be different. But let me show you a standard cash flow statement. So if you guys are ready, help me type CF for cash flow. Okay, now, again, I prefer to use the real example. So it's easier to go through it. And we have been using Walmart. Let's go back to use Walmart. So on 𝗲𝗃, you click on financial. You can click on income, balance sheet, and cash flow. Now, let's click on the annual cash flow. Actually, it doesn't really matter, but the whole key idea is this. Now, a cash flow statement, right, you can see there's many line items. And if you do know how to read it, right, it can be a little bit confusing. But let me share with you how the principles of it, and then you'll start to understand, oh, this is how it works. So you can see, right, this is cash flow from Walmart, okay? So let me make sure that I'm right. This is 2020, 2024. We can see a few things. There are 3 big categories. You think of this like a bank account of Walmart, okay? So you can see there are a few categories. First category is operating activities. Now, the operating activities, right, is mainly how Walmart make money. So what is Walmart's operation? Can you all please help me type down? Okay, very quickly, what does Walmart do? How do they make money? They make money by selling items, okay, maybe, okay, sell goods, yeah, that's right. So this is their main operating activities, okay? So basically, if you want to take a look, I'm going to skip through most of it because in my slides, there will be specific step-by-step exactly what is happening. I'll go through a few of them so you know to read the rest. But basically, operating activities is one of the most important to see whether this company is making money from their main business, their main operations. So at the end, you can see that cash from operations, it is positive, $35 billion. Let me confirm. It's in millions, so it's 35 billion. And this is how much cash they actually make this year. Real, cold, hard cash. I don't know why is it cold and hard. I thought cash is pretty warm and nice. Okay, but 25 billion, 36 billion, 24 billion, 28 billion, 35 billion. There is actual cash coming in from their operations, from their supermarket. Cash is real. Okay. So now, later I'll go into the details of it. The second portion of it, right, is cash from investing. This is the portion that you have to understand. What does it mean by investing? Investing typically means, example, they buy a new building. So you can see from investing, wow, Walmart seems to be very bad in investing. No, that's not the case. Well, when we talk about Walmart investing, right, it's not as if they buy and sell stocks. They don't do that. They buy and sell buildings. Okay. And then after that, when they buy a building, they will start to do like maintenance, capital expenditure. Okay. If let's say you look at aircraft companies, right, they buy new aircraft. So investing, when you see minus, may not be a bad thing. The money goes up from the bank because they are investing in new assets. Does it make sense? If it makes sense, help me type CI. CI for cash from investing. So the last portion, cash from financing. Now, before I explain, let's take a look first. So cash from financing is negative. Oh no, what is happening? Now, again, if you do not look at cash flow statement, you'll be very confused. So is it good or is it bad? How come so much money flowing out? Now, cash from financing is this. Financing, basically, a company can finance their businesses in 2 ways. One is they borrow money. Example, they borrow money from the bank. Okay, you can see this long-term debt. And you see a positive number, means that it goes into the bank. So long-term debt, you see 4.9 billion of long-term debt. What does it mean? It means that this year, in 2024, okay, that year, last year, they borrowed another 4.9 billion, and that 4.9 billion was credited into their bank. So you see, oh, the bank, wow, got another 4.9 billion. May not be a good thing because it is borrowed money. Got it? Now, you can see a 4.2 billion minus. What does it mean? They actually pay off some of their long-term debt. Probably they borrow from the bank, or maybe a certain bonds, and it's time's up, so they actually minus. So minus may not be a bad thing. Okay, they're paying off their debt. So this is how they are financing their company, okay, through debts. Now, another way to finance your company is to ask shareholders, can you be my partner? Can I sell my shares to you? And when I sell my shares to you, you are giving me money, correct? And this money, I mean, it can go a few ways, but typically just understand that usually when I ask you to be my partner, I need your money to grow the business. It's not I want to sell my business off, okay? So example, look at this. Issuance of common stock. When we say issuance of common stock, right? Okay, so far it's minus negative, right? Or rather nothing. There's nothing here. So meaning to say Walmart did not ask for more money from their shareholders. They did not issue more shares to get more money in. In fact, they have been repurchasing their common stocks. So they are saying, okay, anybody want to sell your shares? You can give to me, I'm going to pay you. So they are buying back shares. Can you see? So how do we know they are buying back shares? They buy back shares and they pay money to shareholders. You can see money goes out. So is it a good thing? Let me ask you this. If you are a shareholder of Walmart and you see Walmart buying back shares, taking the money that they make year on year to buy back shares, is this a good thing? Yes or no? What do you think? Y or N? For those who don't know, it is a good thing. Okay, so imagine, let's say there's four of us. Let's say four of us, Tom, Dick, Harry, and Sean. Okay, Tom, Dick, Harry, and Sean. We are shareholders of this super big supermarket that's making a good money every year. And because four of us, we are equal shareholders, we are 25% owner of these shareholders. So if the company makes 1 million every year, they give us dividends, they want to pay everything, we are taking about $250,000 each. Now, assuming the company say, okay, we want to buy back, there's a policy saying we'll buy back any shares for those who want to exit the company, and we buy back from Tom and Dick. So it's left with me and Harry, correct? Sean and Harry. So instead of 25% of the company, now each of us, we own one share each. There's only two shareholders. It becomes 50% of the company. And if let's say the company still makes 1 million, instead of 250,000, now I'm going to get $500,000. Can you see? So when there's a repurchase of common shares, it is something that's typically good. And of course, they also pay dividends. Now, why is paying dividends under financing? Because in order for them to get money from shareholders, they must understand that the cost of financing to their shareholders is typically paying dividends. So this is the amount they pay. They pay about 6 billion pretty consistently, and they pay more and more every single year. So now this is the total dividends paid. Sometimes they give special dividends, but from financing, okay, cash from financing is minus. Why? Because they pay dividends, they buy back shares, they basically take in less finance. They don't need so much money to finance. How many of you are still following so far? If you are still following, help me type 1. Okay, the number 1. So these are the key things. Now, what do shareholders look at? Okay, but before that, let me go through a few things. In fact, just now I mentioned about investing and financing. It's pretty simple and straightforward. I borrow money, money comes into the bank. I pay money, money goes out of the bank. I pay dividends, money goes out of the bank. If I actually sell my equipment, money comes into the bank. If I do capital expenditure, maintenance of my machineries, my whole entire warehouse, money goes out of the bank. This is very straightforward. Now, the confusing part is operating. Operating seems to be easy, but actually it can be confusing for those who are not trained in accounting. Let me show you this. Okay, so you can see in accounting, right, you will see the first line is net income. I need to explain to you that this net income, $15 billion, this number is called a base number. Where do they get this number from? They didn't go to the bank and calculate that 15 billion. They do not do that. Okay, they will do a check at the end. But initially, right, this 15 billion comes from here, comes from income statement. Okay, let me just confirm. Where is the... Okay, here, 15 billion. Can you see that? So this $15 billion comes from income statement. And we already know that income statement can be manipulated. Remember, the revenue can be from another 𝗲𝗏𝗂𝗶𝗽 company or something like that. Okay, but this income, right, from the cash flow comes from the income statement over here. So the income is called the base number in the cash flow. So the first number you see is from income statement. They say, oh, this is the amount of money we make. However, let's counter check everything and make sure that the cash matches at the end with the income. That's why cash flow is very important. Got it? Now, the first thing you will see, right? Okay, there'll be a few liners and my slides will explain it bit by bit. You will see this thing called depreciation and amortization. Now, depreciation and amortization in Walmart is $11 billion. What is depreciation? Because they buy a certain warehouse, they buy very, very big buildings. Every year there's wear and tear, right? Every year there's wear and tear. They will actually have to set aside certain amount or certain expenses to say that we need to save up when it finish wear and tear, we need to have the money to actually buy it. Typically speaking, let me explain to you. Let's say when they buy a warehouse and the warehouse costs them 10 million. This is a simple way of depreciation. A warehouse costs them, let's say 10 million. They will not put it under expenses. By right, you say, okay, this year, this is how much profit we made, how much revenue. we must calculate all our expenses. Now, this year I spent 10 million to buy a warehouse. What they will ask themselves is, how long can I use this warehouse? How long do you think you can use a warehouse? Maybe in Singapore, commercial building is 60 years, but in US, maybe it's forever, correct? But they say, okay, $10 million, let's say we use the warehouse for 10 years. Likely this warehouse, after we buy, we can use for 10 years. So we say, okay, then every year we expense $1 million. Does it make sense? So every year it will be minus 1 million, minus 1 million. We will minus off from our profit 1 million to say that we are using one out of 10 years of the life of the warehouse. So this is how they expense it. So during the net income, remember this net income that we got from this income statement is already minusing off all the depreciation, minusing off everything. So all the expenses is minus off already. The cash flow, we add back the money. You can see. So for depreciation and amortization, we add back. Okay, why do we add back? This is the confusing portion. So I'm going to use this to explain. The rest will be similar. We add back because, right, we say that we spend that 1 million, so we minus off that 1 million from that profit, correct? But actually the money didn't go on. There's no money. It is just an accounting of 1 million. The money has already gone out when we did investing activity. We already spent 20 million to go and buy a new building already. So the money already went out of the bank. So by the time it becomes income and profit statement, right? We say we spend 1 million this year, but already spent 10 years ago, we already spent already. It's already gone out of our bank account. So this money that we say we spend, we must add back to make sure that the cash is accounted for. Okay, I hope it's not confusing yet. The truth is, inside this income statement, when you see depreciation, okay, depreciation, amortization, and things like that, right? No money actually go out. They minus the money, but no money actually go out. So therefore, during cash flow, they add it back to make sure that the cash is aligned. So far, does it make sense? Am I explaining okay? Got it, huh? So you can see a lot of amortization, goodwill, and things like that. When you see them add back, you'll be very confused. Why are we adding it back? Because we already expense off in net income, but no money really go up. So we add the numbers back. We didn't really put money back in, but we add the money back to make sure that the numbers counter. So this is the whole idea of, okay, so there's quite a number of things, investing and things like that. So in conclusion, I'm not going to take out too much time because next week will be the exciting portion already. So this week, right, you can see we have talked about cash flow statement. The previous week, we talked about balance sheet to see what we are buying. So when we talk about balance sheet, we talk about what are we actually buying? What assets are we inheriting over? Let's say you go and buy your friend's business, right? And your friend want to sell you a business. Your friend has been running a restaurant for some time. When you go and buy, you must know what assets are you taking over. Are you taking over the restaurant or not? Sometimes you buy that business, you realize that they are just renting the restaurant. That the building is not even theirs. It is not part of the assets. You must know what is that. Now, if they do buy that restaurant and they own the restaurant, and when you buy, you are getting over the restaurant, you must know the liabilities. Is this restaurant under a bank loan or not? So you must know the assets and liabilities when you buy a company. The next portion is income statement. We have to see for the past few years, okay, have they been consistently making money? Have they controlled their expenses well? Is there a nice growing steady net income? Is the assets also steadily growing? Cash flow, we want to make sure that it matches what is written here. Otherwise, something fishy is happening. This is a fish, by the way. Something fishy is happening. Does it look like a... Yeah, it's a fish. Okay. So, get it? So, these three financial statements will give you a better snapshot. That being said, I want to share with you guys, it still can be manipulated. In certain countries, it's a known fact that businesses of certain countries have a few versions of financial statements. One for themselves, one for tax reporting, one for their partners. You got to be careful with that, okay? So make sure that we actually deal with countries that's more transparent. There's more, I would say, compliance. Like US, it's not perfect, but it's pretty advanced in that. Okay, so that's why you want to actually get listed in US and things like that. It's a little bit more stringent, but we have heard of news like Enron, like even 𝗲𝗃𝗂𝗶𝗽. I don't know whether you all know about the 𝗲𝗃𝗂𝗶𝗃 case. We have heard of many of these issues. So in the end, no matter how nice their financial statement is, always position size. Okay, venture into 7 or 8, like we mentioned that. Okay, Ken? Why do we provide for division? Okay, we provide for depreciation in the income statement, not in the cash flow statement. Okay, so these are good questions. And do me a favor, whatever good questions you have, do also ask ChatGPT. Say, hey, why is this happening? Let me tell you, I also asking ChatGPT because I also cannot remember some of the things. I studied all this when I was in university, which is like 2 or 3 years ago. I'm just kidding. Okay, 20 years ago. Okay, so all this we got to actually know. Now, so I want to share that congratulations if you have been listening to all this so far, because Warren Buffett said you have to understand accounting. You have to understand. You don't have to do accounting. You have to understand accounting. The nuances. It is a language of business. It's an imperfect language. He also said this. One of the most realistic investors and very wise investors. But he say, unless you are willing to put in effort to learn accounting, how to read, how to interpret, you shouldn't select stocks. I wish after years of investing, I also think that not everybody should invest stocks. You can look at investing in the whole index. Okay, I was talking to another investor, a very wise guy. He also mentioned like sometimes you just buy a lot of investment linked policies and things like that. Do you even know what you're doing? Not saying that they are bad, but you must know that you're just buying another stock. Okay, that's the whole idea. Okay, so these 3 weeks we talk about income statement, balance sheet, cash flow statement. We'll put this on the YouTube. Go and watch it. Put the notes and also the slides into the Telegram group. You can go and review it. You don't have to be an expert. You'll just become better. Now, if all this is too much for you to digest, it's okay. It is for us an initial understanding of it. Next week, we'll be talking about financial ratios. So these statements, right, add together, divided by each other, there'll be certain ratios. They'll be able to tell us which companies seems to be doing better. Okay, let me just give you a quick clue. So even for myself, I don't read into details of every single thing every single time unless there's some anomalies. Like suddenly, how come this year the income jumped by so much? Then I'll go and read into details. Typically, I like to look at a very quick snapshot, and these are some of the key numbers that I like to look at. So next week, we will be going through them one by one, and I think things will become a lot clearer, and we'll do a lot more case studies. So next week, do come and join me, and then you can come and share with me. Hey, maybe we can take a look at this stock. Maybe we can take a look at that stock, and we will study some of the stocks together. So this financial ratios, right, is a combination of income statement, balance sheet, and cash flow statement put together. And that's where we have a more holistic checklist to see whether this company is a good company based on their financial results. Okay, so I do hope that you guys are excited and you will learn how to invest. Okay, invest wisely. I hope that it has been benefiting you so far. If you have been getting some value, I know I talk a bit fast because of time constraint, and you are also excited to become a good investor, type V for value. So that's all I want to share this week. Do invest safe and continue to really position size. No perfect investment, and stay safe. I'll see you guys next week. All right, goodbye.